regardless of what stage you are, even if you're not invested in crypto at all, I think there's a really important lesson to be learned, because the psychology behind people and money and bubbles and manias will never change. It is the same. It is constant. You will get sucked in because it seems as though all the people saying it goes up are right and all the people saying it goes down are wrong. And you can't, it's the old adage, the most painful thing in investing is to sit back and watch your neighbor get rich.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate, and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined, as always, by the brain trust himself, Mr. Chase Taylor. Feel like I haven't been here in a spell. And, you know, everything's kind of started out pretty serene today, and then the market just decided to get a really nasty attitude.
Yeah, especially the tech stuff.
Yeah. Did we see any news on that?
Not really. Not
spike
really.
in yields, nothing you can really point to.
Yields were down.
This is kind of what you and I have been talking about recently, and this is kind of the thing that I was a bit nervous about. When you saw the market drift upwards on really head-scratching stuff all summer long, and you saw the positioning getting increasingly more aggressive as that went on, which culminated in, what day was that? Was that yesterday or Monday? The record inflows into ARK, or was that last week?
Like last week, I think is what it was.
Yeah, when you see those signs, when you, like you were saying earlier, see Chamath launching a SPAC at these valuations after these runs, considering economic data, it really feels to me like you're in one of those moments where investors are like concerned that the economy doesn't matter to stock prices. I know that it can sure seem like that sometimes, but I don't think that is a feature. I think that those things will matter. But when you consider all this stuff, it, at least for me, I think there's some reason for pause here, little reason for concern.
Yeah. And just sentiment positioning, frothiness and some of the, less fundamentally backed things in the market. There's just a lot going on. And one of the big things for me is, I'm sure everyone's tired of hearing about, though, is like when all the systematic stuff is full or close to full, that's when I start really watching for problems. And we're there. That stuff's full. So you get a twitch to the downside, and there's a lot of people that have to sell. I'm more comfortable being long when those people have a bunch of buying left to do. It's just a natural tailwind you're going to have. Well, now that tailwind's gone, and it becomes a potential headwind. So there's a lot of reasons to be concerned. And as I talked about yesterday on the show, like the Friday event risk that could combine with some other stuff, it just starts to get a little unnerving. And also, as we've talked about on the show, like NVIDIA, having China kind of push back and go like, yeah, maybe we don't want those chips. It becomes a potential earnings headwind for NVIDIA. Now you're seeing NVIDIA kind of lead the way down. We talked a little bit earlier offline, GPT-5's largely underwhelming. So now you're starting to see a lot of the AI stuff wobble, at least you could call it. So there's, all of a sudden some reasons to be at least short-term concerned.
Yeah. I had some, obviously didn't place any trades on it whatsoever. I don't even know if there really are any. But I'd kind of gotten a tap on my shoulder that they weren't expecting a lot out of this last bit from ChatGPT.
Which is annoying because they made it sound like it was going to be like this giant new paradigm shifting model. And in some some nerdy ways it is, but like as far as like everyday users of it is if anything, is regressed in some ways. So
Yeah, and this is just a feeling. I don't have anything technical to point to. I don't have anything fundamental to point to other than just stretch valuations. But at least in the short term, to me, and you mentioned something about this earlier, but it really, I get the feeling that is some air getting let out of the hot air balloon that is AI. It could be happening.
yeah, I mean, it totally makes sense. And we have the seasonalities we talked about. Like this week is the week where the seasonality really opens up to some downside risk for a few weeks. Like there's all kinds of reasons to be at least, a little more on edge than normal.
Yeah, and when you see what did Palantir get hit for? 10% today?
Yeah, combined with the after hours was 10%. MSTR is broken down on the chart, is down a lot. Bitcoin, gold, silver, platinum all dipped below their 50-day moving average today. MSTR has been getting hit worse than Bitcoin itself, which is notable because a lot of the reason people own it because it's actually outperformed Bitcoin itself, which was a whole other can of worms. But so to see all that is notable. I mean, I think is either Eric Trump or Donald Trump Jr. and Witkoff's son. They just launched, I think, it's a SPAC that was going to do crypto treasury stuff like MSTR, but on some cryptocurrency that hasn't even launched yet. So like the speculation in the crypto space and the crypto derivative space and the crypto derivative of derivative space has exploded, obviously. So like no one can say where were the signs when it comes to a pullback. I'm not saying any of this stuff is going to last for more than a few weeks, but at least for that pullback, the signs are definitely there.
Yeah, I mean, like I said, it really is historically unique. The whole the whole crypto space, the space we're in, the way tech is performed. I mean, I like crypto to me. It cracks me up. Well, is it a bubble? Of course, it's a bubble. The question is when you, to a certain extent, central bankers and the powers that be have figured out how to hotwire markets and not let. And I don't think people really understand that. If you listen to so many of these central bankers talk, and you kind of look through and it's not what they're saying, and it's certainly not what they mean, but you listen to them talk, and you're like, okay, so you think your job as a central banker is to keep bubbles afloat, right? To keep them inflated. And that's not what I said. Well, yeah, it kind of is, right? When your attitude is constant liquidity, like sometimes there shouldn't be constant liquidity. And in a world of constant liquidity, you're going to get really weird things, right? Because
like financial alchemy,
right?
Which is kind of basically what this, all these crypto treasuries are. And those, like one of those IPOs, like every week now. So
I know, and so guys, for people, like just learn a lesson from this, regardless of what stage you are, even if you're not invested in crypto at all. I think there's a really important lesson to be learned because the psychology behind people and money and bubbles and manias will never change. It is the same. It is constant. You will get sucked in because it seems as though all the people saying it goes up are right and all the people saying it goes down are wrong. And you can't, it's the old adage, the most painful thing in investing is to sit back and watch your neighbor get rich, right? And that is why you have to be disciplined about your approach, and you have to acknowledge that by missing out on a lot of the big pain, and a lot of the big lashings that you'll take, how you miss out on those means you're going to miss some upside at times, right? But when it's all said and done, if you've got a position that goes up 500% and then loses 100%, it's a zero.
Yep.
Right. And that's the thing that so when you're paying the equivalent of billions of dollars in total value for something called Fartcoin, do not be surprised when you wake up to a zero, right? It will happen. There is no intrinsic value. Now, the flip side of that, and I think we've talked about it before, but we've got a good buddy of ours that shall not be named that took a very modest portion of his portfolio and bought a bunch of ridiculous crypto stuff, knowing it was ridiculous. And his attitude was, this is like a call option. If it goes nuts, great. Right? He made
Went nuts.
bloody pile, right? Sold it all. Took the cap gains hits and went, okay, that worked even better than I thought. But with it was some discipline. When those positions went down, he wasn't adding to it, right? He like basically said, okay, here's my nut. That is all I'm throwing in.
Treat it like an option. It's going to zero or it's going to a lot.
Yep.
And I'm taking it off either way and moving on.
Yep. And I think I personally believe all crypto outside of Bitcoin, maybe Ethereum, should be treated like that. I think you can make an argument that Bitcoin should be treated like that too. Bitcoin feels different to me for several different reasons if you want to just hold it long term. But even then, don't let it get too big as a portion of your portfolio. And here's the simple reason why.
But don't let anything get too big in your portfolio, though.
Well, but especially when you don't know what something's worth.
Yeah.
Okay, like if you don't know what it's worth on any, well, I know that's what. No, that's the last transaction price. You have nobody does. We own Bitcoin. I'm not saying no Bitcoin. I'm just saying if you can't tell me what the actual value of an asset is, it can't be that big a position in my portfolio. You can speculate, right? Like you and I have said this so many times. And it sounds like sacrosanct. It's like it sounds like I'll immediately convince everybody that hears this that like I'm a complete idiot and don't know investing. But it's just true. It really isn't. The issue is not what you own. It's how much. I mean, you can own the most toxic stuff in the world in your portfolio. And if you keep it sized right, it won't hurt you.
Right. And to go back to what you're talking about with that individual's like little bet there, like it's similar to what we do ourselves with our portfolio, like where there are regimes, which we're not in as much right now, like based on what I was just talking about, but like where you need right tail hedges, where you need not 30, 50, 70%, but like a few percent of stuff that like, hey, if this gets a little unmoored, this stuff will, hey, the S&P will have a nice 40% year. This will have a nice 150% year. I at least need a smidge of that to help hedge getting us we're not going to keep up on a 40% year. So let's keep up a little more than we would have with some crazy stuff at a small scale.
Yeah, no, and it's the perfect name for it, is a right tail hedge. And when deployed correctly, but we've had those moments, right? Where I've had clients call in like freaked out. What is this doing in the portfolio? You guys said you didn't do stuff like that.
Soundhound was a perfect right tail hedge example.
Yeah. And I go, okay, I agree. But did you notice the size of the position? He's like, yeah, it's 1.1%. And I go, what you don't know is we've stop lossed it 15 basis points below that. So you're looking, if this doesn't work out, you're risking 15 basis points. You won't even notice it.
Yeah.
Right. But I mean, I think that was a perfect example. I think we doubled our money in that one pretty short term.
I don't remember what it was. But it went up plenty and quickly for sure.
Yeah. And so by doing things like that at times, as weird as this sounds, you can actually make your portfolio more secure.
Yeah.
Meaning you can have less money at risk in a run up. Those risky positions, you're walking those stops up just so you're not. And you can stay in a much more conservative footing and still keep up.
Right. Like, so in the last few months, if you had 1% in Ethereum, that would have been like sort of like having 10% in the Qs.
Yeah.
And from a portfolio perspective, from a risk perspective, having 1% Ethereum is more responsible in a sense than 10% Qs. And it allows you to have the other 9% to maybe throw in T-bills and earn 4% or whatever. Like there's a lot of like those intricacies on portfolio construction that they're counterintuitive. They're weird to think about. And then you drill in and you're like, well, I guess that makes sense.
Yeah. Like, I mean, for instance, it took me a long time to realize that. And every time I say it, there's a part of me, you feel kind of dirty, but it doesn't matter what you own. It matters the size. And it's just true. Like you find out, you got positions that rip against you and get you killed or rip your face off. If you sized them correctly, it's not like it's fun, but I mean, nobody's going to go home and cry in their beer because they were down 25 basis points on the day.
Right.
And if you've got a position that's 1% of the portfolio, that means you took a 25% header. Anyway, yeah, I just,
This reminds me of a quote from this Roy Sutherland book I'm reading, and just made me think of it. The book's called Alchemy. He said most darts players aim for the triple 20 because that's what professionals do. However, for all the best darts players, for all but the best darts players, it's a mistake. If you're not very good, your best approach is not to aim at triple 20 at all, but instead aim at the southwest quadrant of the board towards triple 19 and 16. You won't get 180 that way, but nor will you score 3. It's a common mistake in darts to assume that you should simply aim for the highest possible score. You should also consider the consequences if you miss. Now it's a little bit more of a left tail argument, but like I just love that metaphor for darts though.
And the reason I love it is, and I really am not very impressed with myself. I'm really not. I'm too aware of my faults in investing and in life. But when I hear a quote like that to me is one of the things that I wished I would have learned earlier, right? And that everybody needs to learn, because it's not if, it's when, right? You must play the percentages with the full acknowledgement that you probably will, odds are horribly against you to catch the fastest moving train, right? The key is not to get on the one that goes backwards.
Exactly. Yep.
And that's it. And
avoid that risk of ruin is the key.
Yep. Avoid the risk of ruin. I mean, and look, part of it is, especially in an inflationary environment, you got to make money, right? Like I get that. I just, right now, and we've been saying this for a long time, you just kind of keep seeing it metastasize. Right now, there's just so many people out there that are not adhering to any of these rules. And, you see these moves and things like Palantir and all. And I think people just are like, well, that's just what it does. No, guys. That's what things do when they're trading ridiculously over their skis, right? That's not just a feature of Palantir. That means that the market on any given day, you've got a gap a mile wide between what people think the thing is worth. And when you have a gap a mile wide, it usually is only a matter of time until a gap down is realized.
Right. And what, the tough thing is when everyone's throwing at the triple 20, like you get in a situation where like everyone owns it. And then that means you have everyone who's a potential seller of it. That's why I don't like things that have already ripped, because I know everyone already owns it. And every once in a while you can find something that is actually inflecting and people still don't like it. And those are things you jump in with both feet.
Yeah.
But usually, take a look at Robinhood. Promise you, everybody that trades single stocks that's under 40 years old probably owns Robinhood. Every momentum fund on earth owns Robinhood. Like everyone owns Robinhood. So like if it starts to have a problem and hits stops, it's not like, the 5 little mutual funds have to sell it. Like everyone's going to have to sell it. And the same for Palantir, like all that kind of stuff. Like anything that's on fire, the chances of all that massive selling is there. And I feel like people don't think of it that way, but
this is switching gears a little bit. I know you guys, I got stuck on client calls, so I had to miss our investment call, which drives me nuts because I actually, I don't know about you, but I always look forward to that. Mm-hmm. And I'm sure Jamie walked you guys through some of did he talk about stock-based comp at all?
Not today, no.
Okay. So he and I were going back. Jamie, again, is our junior analyst. He and I were going back and forth over the weekend because he was digging into DocuSign for me. And we've known this stock-based comp thing for a really long time, right? But there's a dynamic that I was asking him to look in because I can't remember how we got there, but I just started thinking, I was like, you and I both know what happens when a stock takes a big hit and then stays down for a long time. It starts getting liquidated, right? When you look at some of these companies and the valuations they're still trading at, yet the pedal is off the rose for a lot of them. They're still sitting on big losses. And you look at the amount of stock-based comp these guys were issuing, and you think of those dynamics, right? And I think they're different than a lot of people would think they are. Meaning, I think sitting on really big cap gains on RSUs, restricted stock units, I actually think that is less likely to precipitate selling. right? People are like, well, when a stock's going up, oh, I don't want to take the cap gains hit. You know what I mean? Like all that stuff, right? And a lot of them it's restricted or they can't do it, you know? Well, what happens? Think of the psychology behind an investor. And I actually have a client. He's well off. It didn't matter to him, thank goodness, but he worked for DocuSign. And at one point, his stock options were worth well over $1 million. I think at present they're worth like 100, right? So my point in bringing all that up is I'm starting to wonder if stock-based comp at some point is not going to become a problem. Because with some of these companies, when you look at the amount of stock-based comp and you understand what that allows them to do on the incomes, when you understand the I don't want to use the word manipulates because it's legal and a lot of these companies do it, but it really muddies the water of understanding what that company's margins really are, what their cost to operate
if you
really
just look
is.
at the headline numbers on the income statement each quarter, it hides a lot. If you're not backing out the stock-based comp to make, if you don't look at the numbers with and without it and then rectify, you really can hide a lot.
Well, here's the other thing.
There's companies that look really profitable until you back it out and you're like, whoa.
Yeah,
so
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
Well, here's the other thing. Every dollar that stock drops in price, that stock-based comp gets more and more expensive, right? You got to issue more and more stock to cover that deal. And when you look at the percentage of stock-based comp of overall comp on some of these companies, you're sitting there going, if you guys actually have to pay your labor costs, which, you know, the longer your stock goes down and the less it rallies, the less attractive that stock-based comp is. Right. The more likely people are to sell it. If they want to go buy a new car and their stock that was worth $500,000 is now worth $45,000 and they don't have a cap gain sitting on it now, you know, just think about the psychology of that. They're not thinking about it going to $1 million anymore. They're thinking, hey, at least it buys me a car for cash. Right. I honestly believe that this stock-based comp could at some point become a problem. And Jamie's looking into for us, really digging into some of these vesting schedules and trying to understand when big amounts are going to come due. Because like I said, I think especially the companies that are sitting on substantial losses, I think you're going to see those things come under serious pressure when a lot of that restricted stock becomes free trading.
Yeah, that makes perfect sense to me.
And then I think it's going to be, it could very potential kind of set up a, kind of a double whammy, which is, you know, the minute the market sees that, you start hitting more paper on the streets, right? Then you start realizing everybody's looking around going, oh, the stock's dropping. Oh, what is the act? Because no one's
it can make its own feedback.
Yeah. And guys like you were talking about this, but let's be honest. The vast majority of people that own these stocks have no idea what the stock-based comp is, what the percentage of the mix is of the total compensation is. And bottom line, you look at a bunch of these tech companies, and I'm not being hyperbolic when I say this. If you're looking at the numbers they put out, they're not at all representative or accurate of their actual cost of doing business. They're just not. Right. And with a lot of them, you've got a trailer of massive amounts of stock-based comp that's going to be coming onto the market in the next 5 years, right? Just vesting every single year. And if you got a company, and when you're growing revenues at 30% a year and your stock's going up 60, 70% a year, there's no problems. When those dynamics flip and that growth rate slows down to 10 or 11%, and all of a sudden that stock's sitting on a 50 or 60% pullback from its high and is stagnating, you're going to get sellers. Now, eventually, I would think that dynamic would result in probably some really good buying opportunities. But, you know, with a market that's trading at 32, 33 times earnings, whatever it is, it's hard to make an argument that's the case now.
Yep. And you have companies doling out more than 10% of their revenue in stock-based comp, in some cases. Yeah.
And then go look at their margins.
Right.
We were just like sitting there going, dude,
big difference.
You're paying out half your net margin a year in stock-based comp. That's insanity.
I mean, there's some of these companies aren't even profitable and they're paying out, 10% of revenue, not earnings, but revenue.
And unfortunately, a lot of it is still restricted. And so the average investor isn't feeling it because they don't know, but you've got this wave coming at you, right? Redemptions, man. And I honestly, I'll be shocked if that doesn't create some waves. When, who knows?
Right.
But it was just kind of one of those things where all of a sudden digging into this week, and I went, I'd looked at the stock-based comp numbers on DocuSign, but the last time I'd looked at them, the stock was substantially higher and the company was doing better. And it was one of those things where you went, oh my goodness, wait a second, there's a problem here.
Yeah.
And I wonder, I'm really curious if anybody's done any work, and if anybody listening to this knows of any, please send it our way. But at some point, market cap versus stock-based comp, those things have to come in conflict, you'd think, at some point. See what I'm saying?
Yeah.
And I'd be really interested to know if anybody's done any work on that, if there's any, any info about that, because it just makes too much sense.
Yeah,
And
I'm looking forward to hearing more for sure.
Well, and the thing that's so interesting is we've heard a lot of guys talk about stock-based comp, but it stops right there. I haven't heard anybody really dig into it. Somebody has to have, I guarantee it. But I just don't think people realize what a difference that, because basically, and I'm not even sure how the accounting works, or I don't understand why it's allowed. It makes no sense to me.
It makes sense to be allowed. It doesn't make sense to me that it isn't more reported more transparently. That's what I don't get.
When I say allowed, I mean the accounting for it. I'm not
Right.
I'm not saying allowed in terms of stock-based comp.
Or you can just talk about your earnings and everything as if it didn't exist. That's the part I don't get.
Well, I did look. Yeah. The other thing is I don't understand why you're giving restricted status something different. Meaning, they're not free trading right now, but they're gonna be.
Right.
Every one of them is gonna be. So the minute I just think it should be accounted for as issuing stock or compensation on the accounting. And they've got this weird loophole where technically it doesn't count. It doesn't go as accounting until the stock becomes unrestricted.
Right.
What else in accounting works like that? Everything else works the opposite, right? Which is when the transaction takes place, you've got to realize it right now.
Yeah.
It's just a weird,
or at least you have to start realizing it. Yeah.
Oh yeah. Yeah. Maybe you'd realize it on a 5-year schedule or something else, but they can just pretend like that. They can basically say, no, we didn't pay our employees.
Yeah.
You know what I mean?
Right. Yeah. No, 100%.
The accounting rules. There's so many things I don't understand. Meaning you look at, well, we got to watch out for investors. We got to clean up. And you're going, well, what about that? Like in tax policy, like I'll always go back to the carried interest loophole. Why does that? You got all these people concerned about rich people making too much money, and yet you don't close the carried interest loophole?
We came real close a couple years ago, and then one senator got bought off, and it ended.
And here's the sad part about it. I've had multiple conversations. A lot of people out there think that every rich person or everybody that's in finance is using the carried interest loophole. You're like, no.
Most aren't, honestly.
No, and Warren Buffett's like, my assistant has to pay a higher tax percentage than I do. Well, I pay double the tax percentage that his assistant pays. You know what I mean? Yeah. That carried interest loophole just drives me nuts. Anyway, my point is, I think you really need to watch out for the stock-based comp, and also, my get off my lawn moment of the day. The accounting that we have accepted, or the lack of accounting, I would love to have a regulator in this room and go, please explain to me how this is beneficial for anybody other than the CEO trying to pump a stock. Explain it to me.
Sometimes you just got to yell at the clouds.
Well, I already did that. I yelled at the walls. I yelled at the clouds. I threatened to kick the dog. She's too cute, so I never would. But yeah, all that stuff. What else have you seen?
Let me rip through the markets because I just realized we haven't.
We haven't done the rundown.
S&P was down 0.59. Doesn't sound bad, but Q was down 1.36. IWM was down 0.77. Equal weight, and this gives you the vibe that some weird factor stuff was afoot. Equal weight was up 0.47. Mag 7 down 1.6. All world ex-US down 0.24. Dollar was up a little bit, up 0.15. Another down day for oil, suggesting peace can come to Ukraine, down another 1.5%. A bad day for nat gas, down over 4. Gold down about 0.6. Silver down almost 2. Same for platinum, palladium. Copper down about 1. And then yields, you're down 1 basis point on the front end and 2 on the long end, 2 to 3. And vol woke up a little bit today and was up about 2%. So
Yeah.
a little bit of spice on the basically on the tech side and some of the commodities. Like the average stock was okay, but not if it was tech and not if it was kind of commodity based.
Today kind of had the feel of somebody getting blown up or trying to get out of something.
It did feel like somebody had to dip out of a, like almost like a long Nvidia short, a few things in the middle
Equal weight
stock or something.
Yeah.
Something like that.
It was interesting. Yeah.
I blame Chamath, but
well, I mean, he's blameworthy.
The market was immediately punished for 1.44% on the Qs after his announcement. So.
Oh my gosh. And I don't understand why I greed or the need to be in the spotlight. If I was a guy like that worth that kind of money, what in the world would you be trying?
Especially when all your last however many SPACs ended up just brutalizing the people that you sold it to.
Right.
To do it again. And he my favorite was that he polled people on Twitter. It's like, should I launch a SPAC?
I remember that.
And it was like overwhelmingly like, no, dude, please don't. And there was like a community note that'd been like, hey, don't put money with this guy. He's gonna lose your money. And he's like, cool, I'm doing it anyway.
Here, a little philosophical moment for you. Generally speaking, I'm a believer that most people are better than you give them credit for.
I'm okay with that.
I think that generally speaking, most people are good in the sense that I don't think most people are going to just walk right by you without helping you if you're on fire. You know what I mean? I think that having said that, I've noticed that I also have a tendency sometimes to underestimate greed or perverse motivation. You know what I mean? Because you look at a guy, and I'm not saying he's got, I don't know what his motives are or anything like that. I can just tell you it looks pretty foolish and sounds pretty foolish from the outside looking in. But it's just really hard for me to wrap my hands around the idea of a multi-billionaire like running shady schemes that are going to hurt people. You know what I mean? I have a hard time wrapping my head around that concept.
Yeah. I mean, I totally agree with you, but that's, I have scruples. I wouldn't want to do that to people.
Yeah. And maybe they just don't.
I don't know. Maybe you believe in yourself that much that you're going to pick the right companies to put in your SPACs that are actually going to be real, but
you know what? That's probably more.
I don't know.
I got to believe that's more of what it is.
If you thought Virgin Galactic was going to be legit, like you weren't paying attention though. You know what I mean? Open Door, Clover Health.
Like, this is what he's putting in the SPAC.
These were like the prior ones that, all went down 80% pretty quickly, but he did have SoFi though. SoFi ended up being pretty legit. That's about it, I think. I got to believe that SoFi wasn't quite able to outweigh the losers. No. If you bought all the SPACs he was associated with, you just obliterated your money.
I wonder if there's ever been. I've never seen a SPAC that wasn't shady.
Well, I don't think that's true. Like,
no, I didn't say there aren't.
Just as a vehicle, the vehicle's fine. Well, it's not fine. I mean, it's never made on its own. It's a little shady, but because it gets you around some rules that you're like already like, hold on.
Right. Well, because if your goal was to get a company,
they're almost always very speculative. That part is for sure.
Yeah, and if your goal is to get a company trading public, you can reverse merge a company into a public shell.
You can direct list.
Yep.
There's all kinds of things you can do.
Yeah, you sit there and you look at this. They just seem. The lady doth protest too much, right? Like there's too many shady aspects of a SPAC where I've looked at the way they're structured so many times. It's just been like, I cannot come up with a scenario in which I would ever think this was the best way.
When they come flying to market, usually not.
I guess
is like its own indicator. When people get done with money, SPAC promoters show up on the doorstep, right? And that alone makes it unsavory to me.
Yeah, the only thing that I could possibly, and if I think about it, I'll probably think of a different vehicle that's even better to use. But the only kind of justification I can think for that or think of that is that maybe you think something big is about to
Yeah,
happen.
right. You need the speed.
Yep. And you need the speed. And if it doesn't play out, you give the money back to the investors. If there was a setup like that, I could see that.
Maybe if it's way cheaper from like a pure legal and compliance cost, and you're a small shop, you're not trying to pay Goldman, 50 million to get you on Wall Street. You're just trying to like just get across the finish line and get public.
Yeah.
And I don't know. I have no idea how much it costs to do any of those things, but
see, that's the tough part about it is I mean, it depends on the company. It depends on the size of the thing. But typically you can go out and get a publicly listed shell
right
on the market for a fraction of that cost and just reverse merge into it. You know what I mean? I don't, yeah. Here's what I would say. Generally speaking, if you don't invest in SPACs, you're going to be happy. You might miss on a couple here and there, but by and large, you pick a bundle of 8 to 10 of them. It's probably historically not giving you very good returns.
Yeah, it's not going to be a good batting average.
Any other things that you think are pertinent?
One last thing, and I actually just saw this not too long before we came in here, and that is that there are new steel and aluminum tariffs that went into effect like basically after the close Friday on over 400 consumer items. So this is not on steel and aluminum outright, but things that have steel and aluminum in them, which I didn't really realize they could even do that. But so motorcycles, chemicals, plastics, some furniture components, auto parts, stuff like that.
Deodorant.
Maybe.
It's got aluminum in it.
Yeah.
Anti-perspirant,
the bad
I
stuff,
should say.
yeah.
Anti-perspirant.
So a lot of these like kind of like surprise tariffs along the way, they would do like an exemption for the stuff that's kind of like already floating here, like already on the way. And this one, there is no exemption. So like if you bought a bunch of these car parts or chemicals or whatever, like, sorry, like you now have a 50% markup on whatever that was, because that's the tariff on aluminum.
Oof.
I just thought that was interesting. That's one where like, man, I really hope that gets clarified or goes away or something, because my only thought, and not on 400, would be like, I could understand if someone shipped a air quotes motorcycle and it was like a giant block of aluminum just to get around the tariff. Like I would get that if someone was trying to totally game it. But if it's over 400 items, like obviously no one's doing it. No one's sneaking aluminum into chemicals to get around the tariffs or whatever. I wouldn't think so. I don't know. I thought it was worth mentioning because as far as an inflationary impulse, that's another like little one to kind of add to the basket we already have.
Yeah, and none of that. I don't really see how any of that's going to be helpful to the global economy, especially not at this place. But then again, like I'll continue to stick to my knitting on this one, which is, to me, it's all based on the way it rolls out. A little while ago, I was starting to feel like things were pivoting back toward me being more right on my original tariff thing.
Yeah.
I feel like we're on a teeter-totter though. Now I feel like it's pivoting back to being more like what you were saying.
I think the biggest thing is going to be if it becomes obvious that they're creating inflation, tariffs are creating inflation. Does policy change because of that or not? And does the narrative change? Do we go from, look, these are going to cause some inflation and some pain, but it'll be worth it. We've went to that all the way to, if you think these are causing inflation, like, you're a propagandist. Do we go back to like, all right, these are going to cause some inflation and some pain? Or is it enough for them to go, yeah, like maybe we should lower these a little bit because these actually are a problem? Or do they just kind of stick to the guns and go and keep the party line going of like, nope, these are good, nothing bad about them? That's going to be important, I think.
Here's another concern I've got, which is one of the things that I thought you'd be able to sort of mute out the pernicious aspects of these tariffs was an aggressive rollback of a lot of regulation. And that's the other thing that's bothering me is I'm not seeing that.
Yeah, it's been minimal. Yeah.
And it needs to be a lot more than minimal for a lot of reasons. I'm not the only guy that's saying that, but over the past 12 to 15 years coming out of the financial crisis, and not just having to do with markets, but you've just seen an explosion of regulatory control. And that concerns me because because the relief, I would have thought that a rollback of a lot of that stuff, again, would have just provided a softer landing, with these tariffs.
Yeah, if you can do something, because they've been kind of preaching like, oh, we're going to create a big giant capex boom, like we're going to build all these factories and stuff, and like,
yeah, but you're making all the components way more expensive.
But if you did some stuff over here, but you also got that capex boom at the same time, they could kind of mute each other out. Like when they painted that picture, I'm like, well, I'm skeptical, but like, see what you're saying. Like if you do get that, and maybe it is even painful for a year or two, and then, but hey, like now we got some factories coming on. Like
yep,
I get it. But to date, I'm seeing more bad than good as far as the execution goes.
Yeah, no, that's hard to argue. All right, man. Well, that does it for me. You all good?
Good to go.
All right. Well, thank you guys for listening as always, and keep up with us on social media. Know Your Risk Podcast. Search for it on YouTube, Google. We're not hard to find. BulwarkCapitalManagement.com. Anyway, we'll see you tomorrow. Have a wonderful evening. You're listening to the Know Your Risk Podcast. Download and subscribe at KnowYourRiskPodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.